Hi, I'm Pattu from Freefin Cal, and this week let's take a look at Canada Robeco Equity Hybrid Fund. This was earlier called Canada Robeco Balanced Fund. It has a long history. It started in 1993, but it has just now touched AUM of about 3,000 crores. Uh, it's one of those quiet performers which most people do not take notice of, just like Canada Robeco Emerging Equities, in my opinion. So let's take a look at the performance graphs. So this is a open-ended aggressive hybrid fund. So this can invest in about 65 to 70% of equity and then rest in bonds. And it can take on predominantly it'll be a large cap fund. It can take on a little bit of mid caps. It can have a little bit of small cap exposure. And in terms of credit quality of that bonds portfolio, most of the bonds is AAA or A1 plus, which is the highest rated for short term bonds, and some of it is sovereign rating and so on. It does take a little bit of about 1% or so of less than AAA or less than A1 plus, but not more than that. So that's not really of much of a concern. Credit quality is not much of a concern for this fund. So since the inception of the direct plan, you can see that the fund, that is from 1st January 2013 onwards, the fund which is shown in blue line has comfortably bet the Nifty 50 total returns index, but then we have to dig deeper. What is shown here is the asset allocation history of the Canada Robeco Equity Hybrid Fund. The domestic equities has been hovering about 70% all the time. It takes on high quality corporate debt, which is the orange line. The yellow is the cash. The government, the securities of the gilts is shown in white. So it's a fairly, it's the bond part, like I said, is fairly, the credit quality is fairly all right. Now we need to look at the performance. Let me just make this a little smaller so you can see me talking. So what you see here is 782 5-year data points in each line. Let me make this a little smaller so that you can see the, yeah. What you're seeing, the red line that you see here is the CRISIL hybrid 65% Nifty, 35% bonds hybrid index. That's the benchmark for this fund. The Canada Robeco is the light blue line. The Franklin India equity hybrid is the brown line. HDFC hybrid, which was earlier called as HDFC balanced, is the green line. The pink line is SBI equity hybrid, and the yellow line is ICICI Pru equity and debt fund. Notice that more or less over 5 years, more or less all the funds are performing close to each other, and all of them have comfortably outperformed the benchmark, although the quantum of comfort has come down recently because of the increase in the few of the Nifty stocks. And we are looking at a 5-year period ending between December 2017 to February 2020. And if you do the same thing with respect to Nifty 50, so all the other funds are the same, and then you have the Nifty 50 instead of the CRISIL hybrid index. Again, they have done reasonably well, and except for the probably in the last few months or about a year or so, or at best up to January 2018, the aggressive hybrid funds have comfortably bet the Nifty 50 index as well. Most of them, all of them have more or less performed the same. Now we can look at the rolling risk. That is, what we do is over those every 5-year period, we look at the monthly returns and we find out how each monthly return deviates from the average monthly return over every possible 5-year period, and that gives you the standard deviation. Higher the standard deviation, higher the volatility in the NAV. In the rolling returns graph, the rolling returns line should be as high as possible for outperformance. In this case, in the rolling risk graph, the lower the line, the lower the risk and the better. So if you notice here, let me get rid of my face for a moment so that we can. If you notice here, the red line is the CRISIL hybrid 65-35 aggressive index. All the other equity hybrids, the Canara, HDFC, Franklin, SBI, and ICICI equity hybrid funds are or typically more volatile than the CRISIL hybrid index. This is amusing. So they're able to beat the hybrid index, but they do so by taking on more risk, which is reasonable in my opinion. But it still it's still justification for a hybrid index fund, but I don't think AMCs will bite that. If you do the rolling risk with respect to Nifty, you get a completely different picture. Notice that the Nifty 50 is now the highest line. In the old graph, the CRISIL hybrid index was one of the lowest lines. Now, if you go to the Nifty 50, this is now the highest line, and all the others are below that. So that just tells you that aggressive hybrid funds are able to beat the Nifty by taking on significantly lower risk and get a return comparable, or at least, if not better, at least comparable than the Nifty 50. That's called the free lunch of diversification, and that's really awesome. Canara Robeco is there's nothing. It doesn't stand out in a good way or a bad way. It is just as good as the HDFC fund, Franklin fund, SBI fund, ICICI fund. So you can definitely consider it for long-term goals. Please treat the treat this or any other aggressive hybrid fund, or even most balanced advantage funds or multi-asset funds, are pure equity in your asset allocation, and use them for long-term goals, at least 10 years and above. So it's a very good performer, but not something that most people have taken notice of. So that's what I want to say in this review. If you have any questions, comments, please leave them below. I'll get to it. I've not been answering questions. I'll get to it ASAP. Bye-bye.